Okay, Business 630 students, this is Professor Hassey. It's Saturday, July 1st, and happy Canada Day for our Canadian citizens and happy July 4th weekend as we finish up our fourth week of study in Business 630 Corporate Finance. We're beginning a 2-week discussion now, highlighted by case number 3, which is due, case number 2, which is due July 9th, a week from Sunday. It's a capital budget analysis. And we'll be discussing this subject the next 2 weeks, this week and next week, week 5. We have a review video today to go over a sample problem. We'll also review some of the case number 1 follow-up. All the grades have now been posted as we are reached the halfway point of our 630 course this summer. I urge you all to check your cumulative average in the course up to this point in time. If you have any questions or concerns about your grade up to this halfway point, please let me know. I'm around all this weekend. You'll be having our week 5 video, which will be posted on Monday, July 3rd. So if you have any questions, please get in touch with me now that we're at the halfway point of our class. In regards to our case number 1 work, where you had to do a risk assessment and evaluation of a selected company by you, I graded it in 5 increments of 20% each based on paper focus organization, risk evaluation of the quantitative amounts of part 1, risk perspectives, the qualitative perspective analysis of part 2, the supporting of your abstract in your work, the paper presentation, and APA format. And all of you received a PDF file with this format of your grade and the grade that you received in this course, in the case. I based the case basically on your interpretation of the data that you were to gather on the company. I provided you a sample of an interpretation. Again, each paper, each work was graded based on your interpretation, your analysis. But I wanted to give you a sample interpretation just to give you the format which I was looking for, and just basically what type of data I was looking after in your interpretation. So here's the title page, a table of contents. Now, I didn't take any off if you didn't have a table of contents, but for future reference, all APA formatted papers in my class should have a table of contents. The executive summary or the abstract, you can call it either one, where you state what you're trying to do in this problem, in this analysis. And then the quantitative review, the percentage reviews of finding the beta and the credit rating of your company. Given that beta and the credit rating with a risk-free rate of 3.75, a market premium of 8.75, you determine the market premium. You find the capital structure of your company, what percent of debt is your financial statement in, the most recent one, and the percent of equity, and you go ahead and you calculate the WACC and the cost of equity using the capital asset price model. So notice I have a chart here giving particulars. Didn't have to put in your full financial statements. I put it into a chart format, and then the analysis and the description of that analysis right here. Then in the qualitative review, I wanted to get an assessment by you of the organizational and the market or the risk in the market of your company, looking for key parts of your business that you found in your research. And I wanted you to give some examples. For example, if a company was having liability issues, if a company was having management issues, if the company was having market share issues, whatever. That's what I was looking for in your analysis. But I was looking for some specific details and examples, not some just general thinking or general points about how they're doing in their industry, specific points. That's where I was looking for. And then in the references or works cited, a page that explains all that. So here's a work that's in 7 pages, concise, to the point, and giving me the data of a thorough analysis of this company. And that's what I was looking for in your work. And everybody did a very good job. Some of us didn't really understand, and probably rightly so. You should have asked naturally what I was looking for. And some of you did, and some of you didn't. But overall, it was a solid work of interpretation in an APA format. Case number 2 will be, again, an interpretation more of a qualitative analysis of capital budgeting in a spreadsheet format. And that's where we're headed to next. So now you've been graded through case number 1. Case number 2 is now posted. It's not due until July 9th. You have plenty of time, plenty of review to do that. We're going to be looking at a sample problem today and on Monday in our introduction, our lecture video for week 5, and that'll give you the basis to do this analysis. If you go to week 4, you'll see the in-class review sheet that I posted, which is the template that we'll be using. Today we'll begin the solutions part of this sheet to show you how I go about doing it. So here's your reference for our lecture for this week and next, but I will be posting a solution sheet after our lecture today. And here is that file. If you can say, it's 4 tabs. This is basically what you're going to be doing in case number 2, as I've already posted it, and you can use this as your template as you're beginning that work. And we're doing a capital budgeting process analysis, beginning with determining the cost of capital, determining the asset investment, its depreciable life. That's all given. Then you have to calculate net income. You have to calculate net cash flow. You have to calculate return analysis and the risk analysis of this case. So the first section, cost of capital, you calculate. Then 2, 3, and you're given, and then you do the actual qualitative work in your spreadsheet. We're going to be practicing that here. And what is the cost of capital? The cost of capital is what it's costing the company as of today, as of their current risk and financial situation in the market. What is it costing them to go out and get the funds to invest in an asset? In this problem we're working on here, the investment is $1 million with a depreciable life of 10 years. What is it going to cost them to get the money for that $1 million to invest? And that's called the cost of capital, or the weighted average cost of capital. Here's the description and the definition of the cost of capital. It's made, and many of you probably have had this before. Many of you maybe have not, or it's been a long time. That's why I'm giving you the detail in this review. It's made up of 2 areas: the cost of debt after taxes and the cost of equity. Those 2 areas, and what percent they are in the capital structure. That's one of the reasons why you did the case number 1, where I add you to do that based on a particular set of givens. Now you're going to calculate that yourself with your example in your case number 2. In this example here, the interest rate on the debt is 10%. The tax rate of the company is 20%. What is their after-tax cost of debt? Well, it's the interest rate, 10%, times 1 minus the tax rate, which is 80%. So their after-tax cost of debt is 8%, meaning that the company is actually paying out 10% interest on their debt, but they can deduct a certain part of that debt, in this example, 2%, as a tax deduction. So their true cost of debt is 8%. The cost of equity is the capital asset pricing model that we also had in case number 1, where the risk-free rate is, in this case, 3.5%. The market return with a beta of 1 is 8.5. And this company's beta, quite high, is 1.5. So the cost of equity is that risk-free rate, 3.5, plus the market premium, which is the market return of 8.5 minus 3.5, times the beta of the company, 1.5. You do the arithmetic, it's the expected return of the investors today in equity is 11%. The after-tax cost of debt of the company today is 8%. These can change daily, but remember this analysis is taking a snapshot of the company's financials on this particular day. The company's capital structure is 44% debt, 56% equity. So if I take those capital structures of 44% debt times the after-tax cost of debt, 8%, I get a weighted average cost of debt of 3.52. If I take the capital structure of equity of 56% times the 11% cost of equity weighted, I get 6.16%. Thus, our WACC is 9.68%. That's our cost of capital. That is called the hurdle rate, opportunity cost, the cost of getting money. Variety of different definitions, but it all comes out to the relationship of the risk in the market of debt, the risk in the market of equity in relationship to the capital structure currently of the company. And in this case, 9.68%. So we would put 9.68% as one of the variables here in our capital budget analysis that we're going to complete. Also, I'm going to just give you a simpler version here of that cost of capital that we just did. Again, debt to assets, it's 44% and so on. And that's how we came up with the 9.68%. A little bit cleaner here than all this razzmatazz here, but I wanted to do this to give you the full definition. But this is a shorter version, and this is the version I expect you to use with case number 2. Now that we know the money is costing us 9.68%, our job now is to determine the net cash flow. What type of revenues and net cash is this project going to obtain? To do that, we need a series of variables. In case number 2, you are given a series of variables. Here's the variables for this example. A $1 million investment. Okay. A salvage value of $50,000. Depreciation per year of $100,000. Notice I had these all pretty well preset, which is a nice template for you to use. The units sold per year are 25,000 units a year. That's the budget of this investment's going to produce 25,000 units a year at a selling price of $20 a unit, with an annual inflation rate in the sales price of 2.5% a year. So right here under the first year, I would put in 25,000 units. Just lost my screen here. There we go. 25,000 units times the $20 per selling price per unit. And there's my total sales of $500,000. And notice what happened in the subsequent years. I'm increasing that by the inflation rate given in the problem. This company is estimating that the inflation rate after year 1 will be 2.5% a year. So a total projection of a little bit over $5.6 million of revenue off this project. The expenses of putting together this project are variable costs, which is $8 per unit. Variable costs are costs that stay the same on a per unit basis, but change in relationship to volume. Here, $8 for 25,000 units. So we type in again, 25,000 units times the $8 variable cost per unit. And these will all be given to you. The bean counters or the accountants prepare all this information for the finance team. And notice, again, just like in revenue, the inflation rate for variable cost is 2% a year, and that increases 2% a year, total costs of about $2.2 million. Our fixed costs are costs that stay relative. They don't change with volume. So our fixed cost is given as equals $50,000. And notice they do inflate though, because they are expenses. In the case of fixed cost in this problem, they inflate by 1% a year. And there they are. So now we've calculated our net income. Remember the tax rate in this problem, and I'm going to change that here. Remember our tax rate was 20%. So I'm now going to change that here. Our tax rate is 20%. Change that here. And I'll have to change the formula. You'll be doing the same thing in case 2. So our formula is taking the earnings before taxes and multiplying that times 20%. So in other words, sales, 500,000, minus expenses of variable costs, fixed costs, and depreciation, give us an earnings before taxes of 150,000. Take 20% of that, and there's our net accounting income. Now I have to match this to equal 20% rate across. I'll just slide this over. And now it's automatically calculating 20% of my earnings before taxes. And notice my net accounting income is a little bit over $1.5 million. So it looks pretty good. An investment of $1 million is generating a net income of $1.5 million. But that's not our true analytical cash flow. We have to take into account 3 areas of additional cash being generated. The salvage value at the end of its life, adding back depreciation, which is a non-cash expense, and taking into account working capital, the necessary funds it takes to make the assets available to produce these sales and expenses. First of all, salvage value we're told was 50,000. But remember, this 50,000 is being given to us at the end of the depreciable life once the asset is fully depreciated. So this $50,000 is actually a gain of $50,000. So we're going to have to pay tax on that. So $50,000 times 1 minus our tax rate of 20% gives us an after-tax, oops, excuse me, let me just fix this. Equals 50,000 times 1 minus 0.20 and $40,000. So we actually had a salvage value of 50,000, but it's a gain because we fully depreciated the asset over life. So that 50,000 is a gain. Thus, we have to pay 20% tax. So we net out $40,000 of additional cash flow. Now, is this going to happen? Maybe, maybe not. But remember, accounting wise, the asset is only have a life of how long you can depreciate it. Yes, you might own this equipment for 50 years. But as far as a financial asset, it's only good for its depreciable life. And that's what the basis of this analysis. So that's our after-tax gain on the sale of this or disposal of this asset. Then we have depreciation. We add it back in because it's a non-cash expense. And now we have an animal called working capital. And in this case, it says that working capital is 12% of next year's sales. In other words, we're going to take 12% of our annual revenue and expense that or cash flow it out because it's what we need. In addition to investing in the asset for the equipment, we're going to need $60,000 of additional capital to get the asset operating. It's just like when you buy an automobile, you pay for the car. Is that where your costs end? No. You have insurance, you have registration, you have upkeep. That's what is called working capital. So I have to supplement that in advance before we can expense it over the life. So I take 12% of $500,000, the first year's sales, and that's $60,000 of additional cash flow needed in year 0 to get this asset up and running. So our total net cash flow in year 0 today is $1,060,000. But then as revenues change into the future, we have to take 12% of the delta every year. In other words, if you notice the calculation here, I'm taking year 2 rev sales minus year 1 and taking 12% of that. So at the end of year 1, I have $61,500 of accumulated working capital. Remember, working capital is not an expense, it's an asset. It's net current assets, current liabilities. So it builds. So that's 12% of 512,500. 12% of that is 61.5. So this keeps building every year because our revenues are growing. But notice in year 9, 1828. But then in year 10, to do the calculation, there's no year 11. So there's no more next year's sales. So now we have to calculate what is accumulated over this 9 years. By taking 12% of the year 10 sales, 74,932, and that's positive cash flow in year 10, meaning we've expended cash and now we're giving it back in the final year. Why? Because we've been fully reimbursed by the revenue and expenses of this project. There's no additional life of this asset. It has to be 0. Notice the working capital, if you go across, is 0. It goes out and it comes all back in year 10. Because of that, we now have $2.6 million from year 1 through year 10 of total cash flow on an investment of $1,060,000. Well, that looks pretty good. If you ask me, that looks pretty solid. So I think what we need to do now is make sure that our 4 return analysis, net present value, IRR, profitability, and payback tell us how good this was. So first of all, what is this $2,610,000 discounted back to today's dollars? That's the net present value analysis. What's our discount rate? The cost of capital that we calculated earlier, 9.68%. So now I just go into my formulas function. I look for net present value function, and I type in my rate, 9.68%. That's my cost of capital. And now I just paint from year 1 through year 10. I'm taking those $2.6 million being received in the future and discounting it back to today at 9.68%, and I get $1,556,936. Okay, that means my net present value is the difference between that discounted cash flow and my investment. So my net present value is I'm generating in today's dollars $506,936 on this investment of $1 million. I'm taking the cash flow generated in the future and bringing it back to today's dollars at our cost of capital to determine its relationship to our investment. What is this number in a percent? That's the internal rate of return. Function, financial, IRR. And now I just type in for values. I include in this calculation year 0 through year 10, and I get a percentage of 19.02%. So this project is generating $500,000 in profit or cash flow today in today's dollars, and a little bit over 19% return. Some companies might think that's not enough. Depends on your organization. The profitability index is the relationship of discounted cash flow to the investment. So it's just it's a ratio. So we take the discounted cash flow and divide it by the investment, and we get a ratio of 1.48 times. In other words, we're generating 1.48 times greater than the cost. And the return analysis in years is the payback. How many years does it take us to pay back the investment in cash flow? So in year 1, there's our investment. Here's our year 1 cash flow. We still have $841,500 to pay back. In year 2, we take that year 1 cash flow and add in year 2 cash flow. We're down to this. And now we just take this out a couple more years. And notice by 1, 2, 3, 4, in the 5th year, we have paid back the project. And at the end of the year, $97,600 of cash flow has been generated by payback. Notice there's no present value calculation in the payback method. So what is that in number of years? 1, 2, 3, 4. And then what percent is the balance at the end of year 4 divided by the year 5 cash flow? What percent of that is? It's 60%. So what's our payback in years? 1, 2, 3, 4.6 years. Oops. 4.6 years. Make that nice and neat. There we go. So we have now we've determined our cost of capital. We've taken our variables of investment and what that's going to cost us and generate in cash flows. We've determined in dollars, percent, ratio, and years what our return will be. And we're making a profit. We're getting our money back in less than half the time. I guess you consider this a good project. Now, certain companies have high standards. Apple Computer does not accept an investment in an asset unless it's producing an internal rate of return of 25%. General Electric does not approve an investment in a capital asset unless it's paid back in 2 years or less. So certain companies have certain restrictions, but in terms of just generalities, this is a positive return. We're generating positive cash flow, a return which our cost of capital is 9.68%. We're generating a return of 19%. The profitability ratio is positive, and we're paying it back in less than half the time. This is the analysis you're doing in case number 2. And if I may say so, because I'm going to be posting that this week as well, your course assessment case, then you will talk about that in week 5. The last piece of this puzzle, which we'll do in our Monday, July 3rd lecture video, is the risk analysis. Taking a look how changes in key variables of this case. What happens if we say we're going to produce less or more units? What happens if we change key variables like the selling price per unit, the variable cost per unit, or the cost of capital? How does that affect profitability? How they deviate? That's the risk analysis, and we'll talk about that on Monday. So now you have the basics of a capital budget analysis. You'll be doing this in case 2, and you can start that right now if you like, based on this analysis. I will post this solution after my video today, and you can use this as a template to do case number 2. Remember, in case number 2, you have this template to use and follow, which makes things a lot easier. Okay, so we're off and running as we conclude week 4 with capital budget analysis. You have case study number 2 with a template format already set up that you can use and submit as your answer sheet for this case. You now have in week 4 a sample solutions. And the solution's not there yet, but it will be a sample solution file of an example in this file here. And that'll be your study guide. We'll complete this solution file with a risk analysis in our week 5 Monday lecture video. And this is all the parts you need to complete a capital budget analysis in case study number 2. Again, case 1 grades are posted. There's a solution file as an example. Also, you have your individual grade center has your own grade for that work. Okay, have a great and safe holiday weekend. We'll see you all on our Monday week 5 lecture video. Thanks, everybody.